The typical instrument used by small and medium-sized companies, so the SME, to raise debt in alternative to banks' loan is the mini bond. Mini bonds are medium long-term bonds issued by privately held SMEs, aimed at funding their development plans, extraordinary investment, or refinancing operation. Customarily, in order to be classified as a mini bond, the security new issue should have a nominal value less than euro 50 million, whereas there are no minimum requirements as to the main terms and conditions, including maturity date, interest rate, and repayment. Nevertheless, the maximum size of 50 million is not a real size limit for the instrument, but just an expected maximum size for an SME issuer. In order to issue a mini bond, the following implicit requirements should be met by the company: skilled management, solid business plans, valuable position in the market, strong inclination toward internationalization, ability on adopting capital market practices. The main advantages for a company to issue a mini bond are the following: debt diversification, complementing on the bank's funding, opportunity to stretch tenure of financing, brand promotion and a sort of business model certification by the financial market, opportunity to enhance equity value of the company, reaching optimal liability structures and providing permanent transparency. From a technical point of view, there are several differences between a bank financing and a mini bond, the most important of which are: credit spread evaluation is depending on company characteristics instead of a long-term relationship. Size is depending on the liquidity of the market, not of the bank. No need of guarantor or extra collateral outside the company group. No possibility for the lender to withdraw, reduce, or change the terms and conditions. Access to the capital markets is useful for finance of SME growth, imposing the necessary governance of best practice and transparency, which are fundamental to attract investors. On the other hand, investors can benefit from an illiquidity premium paid by SME into the capital market. However, investing in mini bonds is not for everyone. The yield of an investment in SMEs debt are higher and less volatile than other financial instruments, but the risks associated are not easy to manage. The analysis of an SME can be rather complex, and it often implies a direct and deep know-how in the specific industry, beside the fundamental data. Although in several countries mini bonds investing is open also to retail investors, for example UK, Germany, or France, retail investors' protection is a source of concern, and mini bond may only be subscribed by professional investors in Italy, which are private or institutional investors with specific qualification who have the experience, know-how, and competence to accurately assess investment risk and make their own investment decisions. Following MiFID II, such investors include credit institutions, investment firms, insurance companies, collective investment schemes and their management companies, pension funds and their management companies, as well as individuals or corporate entities. With reference to those two latter categories, the qualifying prerequisites are the following: holding a financial instrument portfolio, including cash deposit, with a value exceeding euro 500,000, consistent and sounding professional experience in banking, financial securities, insurance business, universities, public entities, or public administration. In case of a corporate entity, the professional prerequisite must refer to the entity's authorized representative, often the CEO or the CFO in person. The mini bond market in Europe appears to be highly fragmented, and different regulatory frameworks coexist across states. Mini bonds can be listed unregulated, for example in France, or not regulated market segmented with relatively low cost and simplified procedures, where only professional investors are allowed to trade, for example, in Italy and in Spain, as well as placed through crowdfunding platform, for example, in UK, or privately negotiated. For the specific issuing procedures, please refer to each country regulatory framework. In general terms, considering non-regulated markets, no formal listing prospectus is required. Companies have to provide an admission document detailing and explaining the main financial information on the issuer, the relevant risk factors, and the main terms and conditions of the debt instruments. Disclosure requirements include publishing audited financial statements, disclosing rating to enhance minimum liquidity, the rating required only in some jurisdiction, but in any case, highly recommended, the provision of all relevant information on any change to the right of bondholders and in the terms and conditions of the instrument. The more information you give to the market, the more attention you receive from investors. To this purpose, companies typically involve an advisor who preliminarily carries out an assessment of the feasibility of the transaction and assists the company with the drafting of the business plan. The presence of an advisor significantly strengthens the credibility of the company when interacting with investors. Other subjects involved include legal consultants that oversee all the formal aspects and verify the compliance with the contractual terms, and a distribution manager specialized in mini-bond, for example, private debt funds, broker-dealer, asset management firms, or an arranger searching for investor and managing the placement.